Hi, welcome to T-Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
So for today's video, we wanted to talk about the differences in how your investments are, and more specifically, how are they taxed? Because we get that question a lot from clients when they want to take a cash distribution from one of their investments and they kind of treat it all the same, that all of it's going to be taxable regardless of where it's coming from. And we just thought this might be a good educational video just so that clients or people in general just be more aware of how each of their investments are set up, and maybe they can plan accordingly with how they should take money out so they don't get killed in taxes.
Yeah, no, I think that's a good topic to go over because it's not just cut and dry. I think conventional wisdom, you just look at, I'm taking a $10,000 distribution, therefore I'm going to be taxed on $10,000. And that really couldn't be furthest from the truth. It really depends on what type of account you're taking it out of. And so I think we'll dive into here with a couple of slides.
Yeah, here, let me share my screen real quick. All right, we're good?
Yep, looks good.
All right, so yeah, we just created this quick slide and we'll go more in depth, but basically the question is, well, how is my investment income taxed? And you could categorize your investments into 3 different categories. So you have your tax deferred accounts, your Roth accounts, and then basically your non-qualified accounts. So this would be like a brokerage account or, well, we'll go more in depth, but essentially accounts like that. So
and Roth accounts would be tax-free.
Right, yeah. So basically tax deferred accounts. We'll start with that. These are going to be your IRAs that you've opened up or rolled over your 401ks to, 401ks as well. 403bs if your employer offered that when you're working for them. And those are generally common if you're an educator or if you work in the healthcare system. And then your 457 plans, and these are more government type retirement plans, but they're all treated the same. Essentially, you get a tax deduction in the years that you're working and put money into it. So, let's say that you have a 401k and you're putting in $15,000 a year. That lowers your taxable income by $15,000, and that shows up on the W-2. And the whole goal of that is to save that money now if you're in a higher tax bracket, and then when you retire, only pull out as needed, and hopefully you're in a lower tax bracket. Doesn't work all the time, but that's essentially the goal with these accounts, just to get that tax deduction and then hopefully withdraw at a much lower tax bracket. When you're withdrawing from tax deferred accounts, all distributions are going to be included in income. So if you're taking a distribution from your IRA, let's say it's $20,000 a year, you're having an income from that $20,000, all of it's going to be taxed. And then it's taxed also at your current tax bracket. So if your current tax bracket with this distribution is the 22%, then that's going to be taxed at 22% for federal. And then there's state, of course, as well, but that just varies on what state you live in. But yeah, all of these distributions from tax deferred accounts are going to be taxable 100%.
So Jay, I know you've seen this doing taxes. You do a client's taxes and they say, oh man, how can I save more on taxes? I'm paying so much. And then you look at their W-2, maybe they have some write-offs, but you look at their W-2 and they contributed $8,000, to their 401k. And so a lot of people maxing out those contributions to 401ks, IRAs, 403bs, 457s, that's a great tax benefit to you, because like you said, you can reduce your income in the current year, but a lot of people are not taking full advantage of how much they can actually put into it. Now you have to adjust, you have to save and work it out in your cash flow, but that's a huge thing I think that people are overlooking, is they're not maxing out those accounts, and that's one of the things you want to do first.
Exactly. In 2025, if you're under 50, the maximum that you can put into the 401k is 23,500.
Mm-hmm.
So that's a huge jump from 8,000. And I've even seen this potentially help someone get their income into a lower tax bracket by
Right.
doing, actually, especially if it's a married couple and they're both maxing it out. Because that's almost 50,000 right there of income shielded from whatever current bracket you're in.
Yeah.
But that's how tax deferred accounts work. The next category is going to be Roth accounts. So these are going to be your Roth IRAs that you open up. I have a lot of clients asking if they should do a Roth IRA. Also, a lot of employers offer Roth 401ks, which it's the same as a normal 401k, except you don't get a tax deduction for any of those contributions. They're all after tax, so it's going to be included in your income, so you're paying taxes on that. But the benefit of a Roth account is if you allow it to grow in the market over time, when you do take money out of that eventually, it'll be tax free. Now, there are certain exceptions, but essentially, if you're at retirement age and you've had your Roth account at least for 5 years, these distributions from these accounts are going to be tax free. So, really, Roth accounts are great if you have a lot of years under your belt before you need to access these funds, because you can allow it to grow in the market over that course of time. So this really works out for, I would say, anyone in their mid 40s and younger.
I always, when people want to talk about how should their kids start investing, they just got their first job or whatever, I always tell them, open up a Roth IRA. I mean, all those years of compounding, if you have 30 plus years, even those little amounts that maybe they're going to put into the Roth IRA is so valuable down the road. I mean, everybody likes tax-free money, and the more time that you can have things to grow and compound tax-free, the better. So I really like Roth accounts.
Yeah, me too. Now, I mentioned a couple exceptions. So these are mainly going to apply if you're pre 59 and a half. But essentially, if you withdraw your earnings pre 59 and a half, that's going to be subject to the 10% penalty, and then whatever state penalty is. Now, I will say, let's say you've contributed over the course of your time 20,000 into your Roth, and now it's worth 30,000. If you cash that whole amount out before you're 59 and a half, only that 10,000 growth is going to be subject to the penalty and taxable too. That 20,000 of contributions that you've put in over the course of its time, that's essentially just treated as a return of contribution.
Right.
And how it works too is if you take money out systematically before you're 59 and a half, your contributions are deemed coming out first. And then once you hit that level, anything you pull out after that is going to be the growth. So it's contributions first and then growth.
But you want to do everything you can to avoid, taking out those dollars if you can, because again, tax free down the road is the biggest win in anybody's book, really.
Right. Yeah. We don't really recommend accessing these accounts until you're at your retirement stage.
That's not because you need to go buy a car. That's like worst case scenarios is why you would access that.
Exactly. Yeah. And then the final set of accounts is going to be your non-qualified accounts. This is going to be a brokerage account. There's accounts like non-qualified annuities, or even just like your bank account or CDs. These are all they're similar to Roth accounts in the sense that when you take a cash distribution from these accounts, that's not taxable. It's only going to be whatever these accounts have made over time. So if you look at this third point here, taxes are only owed on any dividends earned, any interest earned, and then if you had to sell any investments in that account and it made a capital gain, then those are going to be taxable. So I get clients confused because they'll say that they need to get, or that they took 50,000 from their retirement account and they're worried about the taxes. Well, then when I dig a little bit deeper, I find out it's from their brokerage account and they already had 30 grand in cash, and then they just had to raise that extra 20 grand. But by doing so, their capital gain was only about 5,000.
Right.
So that definitely relieved them when they found that out. But yeah, that's how these accounts work. You're only taxed on whatever the income is earned. And then with brokerage accounts, if you sold any investments and it generated a capital loss, you can take advantage of that and write that off as a deduction up to $3,000 a year. So if you had a $5,000 loss, you can take 3,000 of it in the current year, and then the next tax year you can take the rest of that 2,000 as a loss as well.
Going back to that third point too, I get this all the time, and honestly, I haven't researched it. I don't know if this was a law at one point, but you basically pay tax in a brokerage account on dividends and interest in the year that they are, received, and capital gains, regardless if you reinvest it or not. So people always are asking, well, I didn't receive the money. I didn't get a check or a direct deposit to my account. Why is it still taxable? In those types of accounts, that does not matter at all. If you realized a gain and it created a capital gain, whether you left that in cash, whether you transfer that to your account, or if you bought a different stock, whatever, at the sale is when that taxable event happens. And people need to realize that, because I think people think, oh, well, I reinvested the money. It's not going to be taxable. And that's not the case. The same thing if you have like a mutual fund that kicks off a capital gains distribution. Even though you didn't make a sale of that mutual fund, the manager of the mutual fund was buying and selling throughout the year. They pass that capital gains along to the shareholders of the mutual fund. Therefore, you get a capital gains distribution. You're going to pay tax on that capital gains distribution because of what the manager did, regardless if you receive the money or not. And that's a deeper combo on why ETFs and things are better than mutual funds for tax purposes. But I find that very common that people don't quite understand that little tax nuance in a brokerage account.
Yeah, and this is where it's really good to work with your advisor to figure out what your taxes are, because let's say you don't need any money from these accounts, but they're wanting to do a huge rebalance and you're going to realize a huge amount of gain. That's good for your advisor to let you know what that gain is, so then you can plan for it tax wise. Because I've met with tax clients that aren't investment clients of ours, and they've owed upwards of 30 grand or so just because their previous advisor sold all these investments and just generated such a huge capital gain, and caused them to owe that much, and they weren't expecting that. They would have to tap those funds now just to pay the taxes, and it really just upset them because they just weren't given the heads up, and it was kind of like it was just slammed in the face with that. So we like to work with our clients in tax planning just to make sure that they don't owe any, either they don't owe any additional tax, or that they can just be aware of that and plan accordingly and send in estimated payments. And also, too, just to avoid any unnecessary penalties. So with the IRS, you're supposed to have about 90% or so of your tax paid in throughout the year. And if you don't, they're going to charge you underestimated tax penalty. So it's best to work with your advisor just to make sure that you're all caught up on your taxes. You're knowing what the tax is going to be if something like this happened, and then just send in estimated payments. So that way, then when you file your taxes in the next year, hopefully you just get to break even.
We want no surprises at the end of the day.
Exactly.
Awesome. Are there any more slides, Jay, or is that the last one?
No, that's the last one.
Okay, great. Well, we hope that you found this valuable. If you do have tax questions, investment questions that you would like to ask us, feel free to reach out. We'd be happy to go into more detail or give you our opinion. But if you like the video, please like, subscribe, and we can't wait to see you in the next video. Take care.